Thanks for having me.
So I take it you're bearish on the market overall. Is that like a long-term or a philosophical statement or just a short-term tactical thing?
Tactical, I think, is the best way to put it. And there are ways to express that by being long certain things in the marketplace. And then I think just being short right now, the overall market at 21 and a half times forward earnings with everything going on doesn't seem like a big risk, in my opinion. And I think Powell, what he laid out yesterday was, first of all, that tariffs are maybe ruining a soft landing. But the key to me, which may end up being a positive in the markets, was that he talked about the end of quantitative tightening. And I'm not sure if people picked up on this, but he's basically going to roll off mortgage-backed securities continuously and potentially reinvest those into treasuries. So we know he's been meeting with Scott Bessent on and off, and that's a key point. So something I'm watching just as it relates to the markets in general is what we know, that 10-year yields are the key to everything, or at least Bessent believes it is. And Powell was pretty outspoken for the first time in a long time. And so I take that into account. But that being said, I think the market's expensive. And I think there's a change kind of in the world and economic order, how people view the U.S. market.
But so in other words, and I'd love to know, because shorting the market is so hard, right? I mean, okay, you can go into it when maybe in January, you finally get 14 signs that things are a little overheated. Now you've had a bit of a washout, a waterfall, I think Tom Lee called it last hour. And he said, he thinks there's signs that it's bottomed out. So he had a few of those, technical and otherwise, to mention. You kind of hinted that maybe the 10-year, if it does slip, could be a more bullish development. But are you sticking with the short position until when?
So I just want to say the market may look like it could rally based upon where it's come from. But on an absolute basis, I think the market is still expensive. So I think we are underestimating the impact to the economy of the cuts we're making at the federal government and what that might mean, the knock-on effects into the economy. So I think we're hurting the revenue side of the equation. When your debt to GDP is over 120%, you really can't make a mistake. So I think we are being overly optimistic on how this is going to play out. So I think we're going to start to hear when first quarter earnings are reported that there is a market slowdown potentially and a hit to consumer confidence, which you've already seen, which I don't think is priced into the markets. So
let's play a game, Danny. Kelly, you guys ready? I'm just going to make it up right now. Hey, Danny, it's Brian. What do you think, Danny, is more important for the markets? If you had to pick one, is it potential big cuts in government spending, or is it all the hype and hope around AI?
Well, I think AI is a secular growth trade, and it's certainly an important part of the market. I think that's priced into the market. So if you look at the S&P, obviously I won't run through all the top names, but they make up the majority of the S&P 500. So they're an important part if you are going to short the S&P 500 to understand that. But those feel fully valued to me. I know the guest you just had on, I'm glad I wasn't on the quantum computing segment or AI segment. But, I think that the market itself, I don't think is fully realizing the impact that you just mentioned of cuts, how that will reverberate through the economy. So I think we're getting a little bit overly optimistic in terms of how that's going to play out. And yes, could there be a temporary type of reprieve? Sure.